For a retail investor, credit default swap is treated entirely differently in the US as compared to India. The concept is not alien to us. If somebody were to take a home loan these days in US or in India, the home loan provider might also charge an additional premium to cover for the risk of cost that is involved in case the person going to pay the loan is unable to pay for some risk reason. Let's hear more about it in this video. Let's start with how retail investors touch the CDS world, or rather don't. In the US, retail investors can't buy CDS directly, but their fund managers do. Bond ETFs like LQD or HYG quietly uses CDS to hedge credit risk, giving investors an indirect protection. In India, the RBI allows CDS in theory, but the CDS market is too thin. No asset management company actually uses it yet. So, while US retail rides with an invisible airbag, we can say Indian retail still relies on sturdy seatbelts of diversification and regulation by the RBI. Now, let us watch what happened when the world hit a wall during COVID, say March 2020. The HYG ETF crashed nearly 20% in weeks as credit markets froze. But here's the twist. The CDS market absorbed much of the panic. Fund managers used index CDS to hedge and arbitrage mispricing, keeping ETF NAVs from collapsing in the US. When the Fed stepped in, the CDS spreads tightened and HYG rebounded faster than the bonds it held. In India, the story was calmer but slower. Corporate bond funds fell only about 3 to 4% because they held mostly AAA, PSU and top corporate paper. But there were no CDS to hedge, just good old diversification. So, recovery came not from market mechanisms but from RBI's liquidity infusions and bond purchasing strategy by the mutual funds. So in India, the fall was mild, but so was the bounce. A steady U-shaped curve versus America's sharp V-shape. Here's the perfect metaphor. In the US, HYG had an airbag, painful impact but quick recovery. In India, HDFC Fund had seatbelts, smaller impact but a slower restart. So US model prices agility, the other Indian market prices stability. Both kept the passengers safe, just in different ways. And this brings us to the bigger picture of the retail market. The US retail market runs on market-driven efficiency. The CDS risk is priced instantly through the spreads of CDS and bond. The Indian market runs on policy-driven efficiency. Risk contained through RBI guardrails and liquidity control. One says, let market self-correct through pricing. The other says, prevent systemic shocks through supervision. So both are efficient, one through innovation and the other through prudence. In the next section, let's take the 2008 classic case where credit default swap came to the help of Michael Burry to pay for the bet that he had placed against mortgage-backed securities. Stay tuned.